My name is Michael Gayed, publisher of The Lead Lagger. Joining me for the hour is Tavi Costa, who's always not only a phenomenal follow on Twitter, but is great to listen to and exchange some thoughts with. So hopefully this will be a good conversation. If any of you want to ask questions during this hour, don't hesitate to click on that bottom left button. I'll try to bring you up. If I bring you up, please just keep yourself on mute, and I'll let you know when the time is right. So, Tavi, for those who are not familiar with who you are and your background, just introduce yourself to the audience here.
Hey, thanks for having me, Michael. By the way, you're a content machine. I appreciate your work as well. And last time we talked, I was stuck in a cab in the middle of São Paulo, Brazil, in the middle of a storm. So now I'm in Denver in my house. It's much easier to have a discussion. I'm actually originally from Brazil. I was born and raised in Brazil. I live in the US. I'm a portfolio manager and partner. We manage three different hedge funds: a global macro, long short, and also now we have a precious metals fund that also has exposure to base metals too. Or I think our views or macro views has been we try to at least provide a lot of our views on Twitter through charts and letters, in-depth letters that we write. A lot of ideas to that we think are interesting to capitalize in today's environment that we can discuss. But it's an interesting setup, and we certainly commodity bulls and have been shorting most technology stocks, and we've been long the dollar versus the Chinese yuan, the Hong Kong dollar. Happy to get into any of the topics you would like to.
Okay, so that goes a little bit to the name of the space, but let's first talk about the thesis behind commodities besides Russia, Ukraine, and besides chart line go up, right? Which unfortunately is, I think, the way most people come up with investment thesis. They simply look at what's going up and to the right. Educate the audience here for a bit on what happened to commodities in the prior cycle, why they never really performed that well, and what's changed here.
Well, I think the commodities bull market in general is predicated on the capital spending cycle of natural resource industries. I think this starts from there. In the prior cycle, we've had a declining trend of capex, but not yet at record lows as we have today. On the adjusted to GDP, today we are basically at a 20-year low. If you look at not only capital trends, the labor trends, we've had enrollment for geoscience in undergrad and graduate programs, and also a secular downturn. And so basically, the overinvestment in infrastructure and projects, natural resources, is what drives the cycle here. And certainly, we are very suppressed through just extreme conservatism by most of the managers of those corporations, but also the efforts that we all know on ESG and other political efforts that have been getting in the way. So on top of it, we've had, because of this lack of capital spending, we've had lack of discoveries. And so companies have not spent enough on exploration. And so we haven't seen new discoveries, new projects. Most of the large companies in precious metals, base metals, for instance, have not developed any new large mining project. And so those are going to have ramifications in markets going forward. I would also point out to the environment where I think we're entering, which is an inflationary regime. Inflationary regimes are places where we've had that in the 70s and the 1910s, when rates are deeply negative, when cost of capital is on the rise. And what you got is the comeback of profitability, where folks begin to prioritize profitability again. And commodities, since they're linked to tangible assets, commodities, and so when the prices of those rise, we see the fundamentals improving. So we have, on a free cash flow basis, majority of the commodity producers have never been so profitable. And if not, they're very close to their record levels today. At a time when their prices are still relatively low. I just posted a chart of oil companies as an example. Free cash flow yield is a historical high, close to 8 to 9% right now. And so I believe that the leadership change in markets due to the rising cost of capital, which requires more fundamental analysis, would drive investors into the space as well. there's a lot more to this thesis here as it evolves to geopolitical problems, the pillars of inflation that I believe are kind of creating drivers of consumer prices being on the rise more sustainably. That we can also get into it, but hopefully I answer your question.
Let's talk about the declining trend of capex for a moment, because I'm going to assume that it's particularly true with commodities that and commodity producers that capex will follow commodity prices, but there's obviously a lag, right, with that. And I assume also that there's distinctions between and among different commodities, even within that lag. So, from the work that you've done, when capex starts to increase, how long does it take to actually matter for commodity prices?
And that's an issue that we see throughout history. And by the way, I should point out, see Kevin Smith is there as well. He's my partner. He does a lot of the work as well to help me sound smart in these interviews, but or at least attempt that. And what I would say is those reversals on capex trends they take a long time. It's also the availability of capital that becomes an issue during those times. And right now, with cost of capital rising, you would think that availability for capital for those companies will become even more of a complex scenario. I would say the other issue is geologically is becoming harder and harder, especially in the metals side, for you to find metals. And so we've had in the last 30 years or so misallocation of capital when it comes to exploration. And so I think that's also going to play an important role. And there's another issue too, Michael, which I think has to do with attracting new shareholders to those businesses is the fact that companies are being forced to pay more dividends, to do more buybacks, and so the issue of having to attract more investors to those businesses have forced those companies to pay to almost spend more money or more capital, giving it back to those shareholders than actually spending on their own businesses. So if you aggregate capex and dividends today for commodity producers, they're almost giving more capital back to the shareholders than what they have been spending on capex over the last 12 months. But those trends should take, they usually take 5 to 7 years, and obviously that will change according to each of those natural resource industries. I would say that gold, precious metals in general take a little longer. Energy may go a little quicker. And I, if you start seeing historical highs in terms of capex in general, not just historical highs in nominal terms, but also in the rate of change basis over time. I think that's a time when you should start getting more concerned. I think we're very far from that. We're quite at the opposite side of that. And remember, we're at a very unique setting right now where let's just use oil as an example here because I think it's important. Oil prices are just at around $100 a barrel. Every time in history we've had oil at those levels, we've had the whole industry was booming. So there was no shortage of folks trying to get into geology, trying to get a job with energy companies. Today, this setup is completely opposite, where we're seeing folks actually leaving energy companies in a large scale, and so those are the problems. Is that it's going to take time for us to see the professionals and the knowledge of labor markets to feed into this capex cycle in order to have more supply of natural resources in the future. So there's a lot of things linked here, but I would say the availability of capital linked with the issues geologically and the issues with labor is really what causes the capex trends to take so long to manifest themselves.
I had Joseph Wang on a space. Fed Guy 12 is his handle. It's on my YouTube channel as well, and he's a former Fed trader, knows a lot of the ins and outs of the Federal Reserve. And we were talking about some of the things the Fed does that most people tend to not think about. And one of the things he mentioned is that the Fed can effectively direct liquidity to certain industries, certain sectors. And, when they tend to have kind of a more bluish type of tilt in the way that the government does, that makes them go more towards ESG and favoring things which arguably have made capex lower when it comes to drilling. Talk about how important the role of the government and central banks are to changing capex trends, because I think that's kind of relates to what you mentioned before about liquidity, right, for capex to pick up. But I think that's an important thing to think through. So just kind of experiment with that idea for a bit.
Well, I think there are a lot of things. I mean, some of them are linked to ESG efforts, certainly, and we can talk through that too. But that there are also other things happen in the macro environment that forces changes in policy making that also have impact in natural resource companies. We can use as an example what we're seeing when it comes to the tightening of monetary conditions right now. That makes it more difficult for companies to attract capital and to also raise capital for those projects. I think that's a very important part of what's happening. The second thing I would say is the sentiment is shifting as we see geopolitical tensions rising and commodities becoming a much more a strategic asset for countries in general, and becoming more of a defense strategy to hold commodities and to have a long-term strategy to have natural resources to function your economy. I think we're going to see a trend towards governments becoming more friendly to finding ways of helping companies. But I still think we're not there yet. I mean, we're still getting used to perhaps asking energy companies, for instance, to improve or to increase production. We're at that phase. I mean, we just talk about a phase passing a $40 billion bill to help the Ukraine versus the war with Russia. Well, $40 billion, just to put into perspective, is about what the exploration and production companies in oil spent in the last 12 months in capex. And so that gives you some ideas of maybe there's going to be a point where the government will have to get involved and throw some tens of billions of dollars in order to make some projects in the U.S. natural resource projects economically viable in order to feed the economy through the electrification trends that we're seeing and some other infrastructure revamp and bringing back manufacturing. I mean, there's so many construction related themes that are going to play out in the next 5 to 10 years that you are also very aware of, but that are going to need also commodities. The construction on residential parts and non-residential. I mean, all that is going to need a significant amount of commodities, and so I think that the government will have to get involved at some point. Now, today, as of now, we're seeing some shifts when it comes to geopolitical alliances. We're seeing Venezuela maybe coming into play, which is it has not been for many for over a decade. We've had the issues with Ukraine and Russia. The Middle East is going to play a big part on that too. The problems with China, especially for companies that have their manufacturing plants in China. We have to think about what's the balance of power of economies going to shift from that, meaning companies that will bring back their manufacturing to the US, something that Trump started in 2015, 2016, even prior to his election. But it's now becoming even more pronounced as a narrative. And I think becoming more bipartisan will probably develop as well. Again, this is not any political thoughts, just sharing my views about how politics may play into this. But I think we're at the very beginning of that trend of politicians is starting to realize, and even Elon Musk is starting to realize more recently the pain of developing a new mine. I mean, we haven't, like I said, we haven't seen new developments of natural resource projects, and so people have lost they don't know exactly how long it takes to do those, and we're very involved with those projects. We're very much aware of the complexity of bringing a project into production. I mean, it's brutal. The lack of professionals and capital in general has been very difficult to build new natural resource projects to come into production. Yeah, that's a very good question. I think it depends on the commodity, but majority of the commodities, at least in our view, we've been doing both. We have allocation to the commodity, the physical commodity, but also we have allocation to the businesses involved with those. And I would say it's more of a question of where are the bigger inefficiencies in the market than anything. And I think the biggest inefficiencies are is still mostly on exploration and development. And that is because the majority of the capital that has been now chasing commodities over the last 12 months or so, that we've seen that shift. And I would say, especially in energy and maybe some base metals and agricultural commodities kind of coming back to play. The majority of that capital usually chases the more consistent free cash flow build companies, the companies that have been in production for many years. If you follow gold closely and gold miners, I would say the GDX members and Newmonts and Barricks of the world, the Freeports, those are going to be the ones that are going to capture most of the allocation. And so you start seeing the less inefficiencies in those markets, even though we think those are going to perform very well. But if you're looking for asymmetry, I think the biggest asymmetries is going to be certainly in more exploration and development. The more you go to exploration, the more it requires the geological expertise. And as I said before, there is a lack of that. There's a lack of geologists that actually know capable of discerning what is a good and a bad project. And so we're going to go through a shift of creating new geologists and creating folks that will fulfill those inefficiencies that now we currently have. And so I'll give an example. In the majority of the companies that we are invested, when they put out results, I mean, we're not seeing the manner that we've seen in the past, the types of appreciation of price of those shares when they released very strong drill results. And that's a great example of a market that just doesn't understand the complexity of the geology side of how to really discern if that's positive or negative. And so I think this is a great opportunity. I see it as a great opportunity as a niche for a hedge fund. We focus mostly in mining and precious metals and base metals, but I think I'm sure there are a lot of inefficiencies in energy and a lot of inefficiencies in agricultural commodities as well. I'm just not as involved. So finally, to answer your question, we are involved with both. I think the producers will suffer a little bit of a margin squeeze problem. I think there's labor costs is rising. We're seeing energy costs rising too, cost of capital rising. That certainly it will hurt a little bit some of those producers. And the exploration companies suffer a little less from that because the energy costs and the energy part of their costs is not as high of a weight compared to development and production stories. And so I think in our view, when you hold a high quality exploration asset, where you're holding is something that is in development of increasing the amount of minerals in the ground or finding those discoveries, but also holding minerals in the ground. That's really ultimately what this strategy really is finding that mineral and holding that mineral in the ground as the price of the actual mineral rises over time, creates that leverage to the company. And so you end up seeing those very strong appreciations in price of exploration assets during the beginning of and middle parts of the bull cycle for commodities in general. So Hopefully, I answer your question, but that's I think that's where most of the inefficiencies are.
It seems to me, Tommy, that oil is the most critical of all the commodities because it's the commodity that goes into extracting other commodities. And going back to your point about the government side and allowing for more production and kind of more friendly policies towards commodities. Again, like you, I don't want to make it a political thing, but I find it hard to swallow when you've got right now administration in the U.S. and very loud Democrats basically saying, well, we want to do these windfall taxes on uh, oil and energy companies. Um, how does it look outside the U.S. in terms of those kind of more government-friendly policies for trying to increase production across commodities, in particular with oil?
Yeah, I mean, it's. I should say I could not agree more. I mean, it's as far as today relative to history. I think we're too far from anything that will be remotely positive to really shift the capex cycle significantly. I think if anything, it's just going to constrain even further. And it's been my view, and I think I'm allowed to change my view regarding to that over time if we see big shifts. But it has been my view that the capex cycle may actually take even longer than prior cycles because of the that shift. And just think about what's happening with the strategic oil reserves. Those policies are just so backward looking yet, and yet they're happening at a degree that we have not seen in the past. I mean, we just look at oil prices rising at a time when they have been selling record amounts of reserves over time here in the U.S. Now, outside of the U.S., look, it's difficult. South America is going through a lot of political changes, and we're it's maybe Brazil. I can speak a little bit more about Brazil being a Brazilian. We've got, I think it's really one of the very probably the only country in South America. I guess I can say with confidence that it is the only country in South America that has more of a polarization, politically speaking, from the right to the left. I don't think we have that anywhere in South America. I think that's a positive, by the way. It just creates more debates, but also it causes population to improve their knowledge in general about to be able to to be part of those debates in their families and friends and so forth. I think that's a very positive development happening in Brazil. That over time we'll see the benefits of that. Unfortunately, the majority of South America is still very much left versus pretty much another center or center left party. And that's really what the political debate really is about. There is no polarization as we have here in the U.S. or I would say even more in Brazil relative to other parts of South America, and that certainly has an impact on mining. So we've had Peru being a very difficult place to operate. We've got Mexico being difficult. Bolivia. We've had unique parts of Bolivia that we've been having success with our investments actually in there of places that are actually very mining friendly, believe it or not. Chile has been absolutely terrible for the creation of new projects. And again, I'm speaking mostly about mining, and because that's where most of our investments are involved. I would say Argentina is in the process, in my view, of becoming more of a Venezuela. I think you don't see a development like that happen in a year. It takes sometimes decades. You have many shifts monetarily speaking and politically speaking too, where smart capital leaves the country, and I think certainly that is a trend in Argentina. So we've had success in Brazil, Bolivia, but other parts have been very difficult. They're not mining friendly at all. Europe, I mean, Europe is probably going to go through that shift even faster, given the fact of what's happening in Russia. That's just my opinion, but I still, like the U.S., is still very far from making those changes. You know what's happening with Germany with shutting down nuclear plants and so forth. I mean, so that's still backward looking, and majority of those policies are just so far away from becoming commodity friendly still. Africa, very difficult place to operate. I mean, it's a lot of people that are new to commodities end up looking for investments in Africa because they're cheap. And certainly there's a lot of minerals there. It's a very mineral rich area, but very, very difficult, very challenging to operate. And so very few companies actually know how to operate in that region. Um, Australia, and I would say it's been Australia has a history with mining that is certainly more friendly. We have not had a lot of issues in Australia, but some parts of Australia certainly could be a little more challenging. Um, I would say, Russia and China, we are not investors in those places when it comes to natural resources. We avoid, those types of political regimes, and so we are not involved. I can't speak about Japan very much. I'm not as knowledgeable. We don't have any investments there right now. Um, so hopefully that gives you a sense. I guess Canada is an important one. Canada, even though has more of a left, kind of a left leadership, I would say it's been historically a place where very natural resource rich, that we've seen a lot of production coming from there, and it should continue to only improve from here. I would say will play an important role. So when you think about countries that will benefit from this setting here in terms of the global stage, I think Brazil is in that setup. I think Brazil is a place that could actually benefit tremendously when it comes to feeding the world with natural resources. A place that is geopolitically neutral, and so Canada may play a similar role into that too. It's much more indebted economically speaking, but sorry for the long answer. But I was just trying to think through what are my views about globally here when
Yeah,
it
no, no,
comes to
that's good.
mining.
But one, I don't, maybe I missed it, but I don't think you mentioned China, and maybe that's another direction to go, which is that more and more people seem to be of the opinion that if when these lockdowns or kind of whack-a-mole periods of COVID settle down, that you'll have another reopening type of boom in China, which would then put more upward pressure on commodities. Talk about how you think about China here in terms of the commodity broader trend, and how important is China to overall demand for commodities? That may seem a little bit like a layup, obvious question, but let's talk through that.
Well, I actually think I have a very different view than most people. I think the conventional view of China is that they have full control over commodities, when I think it's sort of the other way around. I mean, completely the other way around. Is China is a commodity importer, strategically maybe rare earth minerals, and so on, some others. But I would say the majority of natural resources, actually, China is doesn't have most of those, and oil, metals in general. And so, they've certainly been accumulating over the years. It's kind of like India in a way, as a commodity importer. I think as we enter this new regime that is more inflationary, that is more pro commodities, I think I'm actually have a very different view that China will have a large impact on commodities. I think commodities are mostly driven by supply, and certainly there's an aspect of it that actually is demand driven, but the majority of it is really through supply, and that's why the capex trends are so important. Um, I mean, we've had to think about this. China was growing, supposedly, their numbers say, tremendously over the last decade or so, prior to 2020 crash, and we didn't see a bull market in commodities. And why? If they're the ones driving the demand, that they're really the economic engine of of the global economy here. So why in the world we didn't see a bull market in commodities? Those are important questions. The other thing I would say is, if you just think about, if I tell you that the second largest economy in the world will shut down about 40% or so of their economic activity, and and I'll tell you, and I ask you, what do you think it's going to happen to cyclical commodities like copper? What would you answer? You would say it would completely collapse. Well, we just saw that, and it didn't. That didn't happen. Copper did not collapse. Copper was down, but it did not. It did not collapse at all. It sort of consolidated. So it goes to show how constrained the commodities markets are when it comes to supply, and why I believe this is a market that has shifted, and I think a lot of people have not figured that out yet. That's just my view again. But I think we're in a place where you want to be buying the dip in commodities. This is not going to be a straight line higher, as we all know, but you want to be buying the dip in commodities, in my opinion, as we get along here through this cycle. And I'm not a believer in overall equity markets. I think that technology and other places that have been crowded, and mostly most of the capital has been allocated towards those sectors. I think we're going to see big shifts of capital that will drive flows into more of profitable businesses that are maybe linked to tangible assets. And it's been my view that commodities would be the replacement of a lot of those flows coming out of technology related sector. Yeah, look, the real estate market is a very important one, and even prior to that, we saw Chinese banks. Some of them are down 30 to 40% off their highs, and those are large banks. I mean, they hold trillions of dollars in assets, and it sounds to me, if we had such a decline in financial markets in China, and I'm specifically speaking about those banks and other parts, and then we saw the ADR companies, the Alibabas of the world, and being crushed by either political crackdowns or problems with the U.S. And China, geopolitical issues, and so it's been sort of a domino effect, in my opinion, from real estate to Chinese banks to growth stocks in China to the overall equity markets in China. But if you tell me that a large economy had its banks down about 30 to 40% from their highs, you would think they would be deeply in a recession right now. And what we've seen so far with commodities has been quite the opposite. They have not suffered from that at all. They actually continue to develop in this what we believe to be a bull market. But it's I think there will be a lot of ramifications from all this. Just think about the shifts that we're going to see in terms of manufacturing in the US. Manufacturing used to account by about 30% of GDP back in the 70s and 60s. Today is about 10%. So that should drive non-residential construction for the next 5 to 10 years, in my view, if we're going to come back and see an economy that is more driven by manufacturing, especially in developed economies in general. Kevin and I we're just looking at some labor trends of manufacturing right now. It is quite interesting that manufacturing, even from a non-farm payroll base, used to be a much bigger part of the economy. Right now it's almost insignificant. And so I think we're going to see those changes. And a company like Apple, for instance, that has certainly benefited from globalization trends, low labor cost. Their margins have been benefited tremendously from that. Will that be the case in the next 5 to 10 years? Will Apple still be able to, manufacture their iPhones in China in the next 5 to 10 years? Possibly, but I think that I think the probability of those things happening in the future here are certainly decreasing drastically as geopolitical tensions increase with Russia and so forth. And so I'm very focused on those changes, because I think I think the market still believes about the story about China, and I'm quite concerned about those. I think we're going to see some shifts there, and I think I've been very bullish on Brazil as well. I mean, the pullback now in Brazil, we've added to some of our positions as a way of playing this commodities market is historically very linked to very correlated to commodity producers over time. We think that there is a lot of cheap opportunities there as a result of those changes. And so, anyways, it's a lot to unpack, but it's I certainly have a different view. Well, I don't think I'm in a place that I can actually opine much of folks going away from LME and other organizations like that in terms of exposing or expressing their views. But I would say what happened there was kind of ridiculous, right? And when it comes to if you're if you're taking risk on something, you should be responsible for that. And if it went against you, you should be responsible for that too. But that was, whatever. That was a little bit outside of what I thought it should happen. But however, no, I'm not. I think ultimately, there's a lot of, I would say, a lot of discussions when it comes to manipulation of markets and commodities and so forth. I'm sure there's a degree of that happens here and there. But I think that the bull case or the macro thesis behind it is much larger than the kind of short term manipulation that we see here and there. And so ultimately, I think you want to be very focused on finding high quality assets in the space. I think you want to. I think there's a lot of misunderstandings of when it comes to supply. There's certainly a thesis for things like uranium, for instance, but it's not related to supply. It's related to political shifts. It's related to where we think energy is going to go from here, how we're going to feed this electrification going forward, and so forth. I mean, there's certainly a theme there, but it's nothing related to supply, nickel or lithium. And lithium is incredibly hard to mine. I think there's the majority of capital allocators that we talk to, the first question they ask is, are you guys investing in lithium as well? Lithium, and according to folks like Quentin, is incredibly difficult to get it out of the ground, and so a lot of people are gonna, and probably I think a lot of people may actually lose a lot of money in those investments in the future here. It seems like a no-brainer, but nothing. There's no such thing as a no-brainer. I would say, I think the market in general is just in a learning curve about the commodity space that we probably have not experienced in many years, and including ourselves. So we've been in a learning curve in general to try to find those inefficiencies, but it's been challenging. It's been it's hard to find folks that actually know what they're talking about nowadays when it comes to commodities.
I'm with you on the Brazil point. I initially was initially a little bit of a joke when I said, Brazil stocks look interesting, and I said that because it basically hit the COVID crash levels. Then it had a huge move, and then I realized there was a huge, very enthusiastic Brazilian FinTwit community. So I get like my most engagement. So I shared in the space here a tweet that got a lot of engagement. Brazil managed this shit way better than the Fed, in the sense that the Selic had been rising really since early 2021. So their central bank did the right thing by trying at least to get ahead of inflation, while ours in the U.S. did quite the opposite. And that will go into business cycles as a later question here. But
Well, I think that's sure, it's a possibility. I think that the biggest deflationary risk to the market certainly is the rise of the dollar relative to other currencies. Something we've been trying to hedge in our portfolios. I think I know you didn't say '08, but there is I think investors have been more conditioned to think about this as an '08 environment when it comes to oil prices rising, forcing the Fed to act the way it did, tighten monetary conditions, and then trigger a recession. I think this is quite the opposite of that when it comes to the capex trends in commodities. Ultimately, I think this problem that we've had of misallocation of capital over the years, too much going to technology and too little going to places like commodities and natural resource industries, is something that will take time to shift. We're seeing certainly some of that right now, but I maybe there's a possibility of a depression. I'm not so much in that camp just yet. I guess I'm in the camp of we're going to see real growth declining. I think we're probably in a recession already in real terms. I don't think it's very difficult to find S&P 500 companies that are growing their top line already over what we think inflation is, which I don't think it's 8.3% or 8.4% on a year-over-year basis. I think it's much more than that. So if you think about that, I think it's going to be challenging for companies, and markets right now think still that inflation is positive for equities. I'm not sure that's the case. Especially when we look back in history, but Mark, I've been struggling with this because it's really we all try to look back in history and understand other times used as an analog. But I mean, have we ever seen a time when we got the debt to GDP problem of the 40s, with inflation of the 70s, with the speculative environment of the 90s and the late 90s and the late 20s? My answer is I don't think we've ever seen this before. And on top of it, you can throw the fact that capex of most natural resource industries are near record lows. I think it creates real political constraints when it comes to the issues with inflation. I think this trifecta of macro imbalances creates real political constraints. I'm not so much in the depression camp, I guess, because I think Paul Tudor Jones said that. If I might steal his phrase, that the genie is out of the bottle when it comes to inflation. And sure, I think inflation is cyclical, just like in the 70s was too, the 40s and 1910s, where inflation certainly can decelerate growth over time. We've had three waves during the 70s, and maybe we're at the end of a first wave here now, and I think that could potentially be the case. But a severe depression where, I got to think about that one, Mark. I don't know. This is not much my base, but
it is an unpopular opinion. There's also a lot of it. I keep going back to this point. The uneducated speculation is astounding. I kept on saying that all throughout last year. I don't think this bottoms until you have that uneducated speculation in a deep depression.
Yeah, I might have a different view. Well, I think the definition perhaps of inflation, that's, I think what you said is undeniable when it comes to the valuation of fiat currencies relative to things in general. But about the shortages being transitory, I think it all depends. Perhaps the logistics side of things might be transitory. I think we crossed the Rubicon when it comes to the trends in globalization. I believe that maybe perhaps it started in 2016, but certainly we're much more. It certainly has exacerbated more recently with Russia and Ukraine, maybe the the pandemic problems, and I don't think that. I think that's I call it the fourth pillar of inflation. I think that is very inflationary. Let's see, another thing I would say, perhaps we may have different views, which is absolutely fine, is on oil. I think that, as I said before, I think commodities markets and cycles are predicated on capex trends, and demand does play a role into things. In '08, we've had capex for E&P companies, for instance, in the oil space was about $150 billion annually at the peak of that, and Today, it's about $40 billion. You think about where GDP was and where GDP is today. We should not be spending that. I mean, we should be spending way more than that. And so, how do we fix this in 3 quarters or so? And it's going to be difficult. And so, until we make those projects to come into production, so I've been struggling thinking about the how much of what's the degree of transitory when it comes to the commodity side. I think that is and I think there's something more trends that could perhaps, and I know there's a whole thesis behind wages and salaries when it comes to in real terms it's not rising, and if you see a squeeze of margins it may hurt wages and the growth in wages that we've experienced since we came out from the 2020 crash. I think that's you can have two arguments there perhaps, but what I call the four pillars is sure the wages and salaries, but also the supply constraints on the commodity side specifically. The third one being, I mean, just think about the amount of fiscal stimulus that we're seeing. I mean, this is one of the most aggressive fiscal fiscal agendas we've seen relative to where unemployment is and relative to where inflation is in history. And I don't think we've seen any degree of that with unemployment rate, how low it is, and inflation being at 40, 50-year highs. Fourth one is the deglobalization. I think it's hard to measure, but I think it's a real trend. I think protectionist policies are on the rise, and I'm quite concerned that will only intensify the inflationary trends. And I understand it's difficult because we just had a lot of inflation, and where if we wear our trader's hat, we're probably thinking, well, things probably markets are priced in too much when it comes to the possibility of further inflation here in the next 12 to 24 months. But let's say you do end up having the D world becoming word becoming an actual scenario. What do you think the Fed would do?
I think this will be really interesting if you have this persistent inflation and treasuries continue to act the way they did last week as a risk-off asset, because that would suggest there's another type of D word, which is that there's a return of a deflation pulse in the long end of the curve. And if that's the case with leverage as high as it is, I've made this point many times last year, and I look stupid for having said it now with hindsight, but I still maintain this idea that the real risk isn't that inflation is going to be long-lasting. The real risk actually would be quite the opposite, because it would suggest that no amount of dollars is able to create the secular long-term inflation, which is maybe up for debate until with hindsight.
Wow, that's a very good question. I don't know if I'm at the if I can really opine with a lot of value when it comes to that. I've my interpretation of what's happening is more of the opposite of how what's going to be the inflationary wave of what's happening with the lockdowns in China. But I think I've had a different view from most folks. I was certainly more in the deflation camp, and I'm very appreciative of the views on that, because I think, particularly with the dollar, and that is why for us when it comes to portfolio positioning, we've had a very large book on tangible assets and commodities in general, energy, metals, and agricultural, and so forth. And our thinking is, if we're wrong about those, how can we actually, what are the things that could potentially hurt our portfolio? We think, in depressionary environment, as Mark was referring to, I would think the equity markets wouldn't be trading at near record valuations. I would think technology and other sectors that have been a large portion of those of those appreciations when it comes to equities, I think would certainly be hurt. And so we've got shorts there. And another thing that we've been very focused has been the potential for devaluation of currencies in a large way relative to the dollar. And I would say it's incredible. We haven't seen any major depegs or any major devaluation of large economies. I'm not talking about Turkey, Argentina, Venezuela. I'm talking about European countries or really Japan or UK back in the 90s. I think the 90s was the last decade that we've had the Asian crisis and so forth. I think that thesis of looking for currencies that have that recipe for disaster is something we're really focused. We've got a short in the yuan and Chinese yuan and the Hong Kong dollar as part of that. I mean, it's just the implied volatility is just so low to what we think could potentially happen, and it just makes sense. Now, to your question, going back to your question, I'm not sure I have a view about that potential increase in inventories when the logistics globally begin to be reestablished here as things come back to more normal. But yeah, I've been I think there's some cyclicality impacts here that may potentially happen with inflation perhaps being near its near kind of more at a peak level here. But if you look at the long term trend of all the structural problems that we have, I think this is a new regime. If you just take a look at, let's say, nominal GDP year over year in the U.S. all the way back to the 40s, we're just looking at that. We're in an upward trend. That was a market regime all the way to the 80s, and then we've been in a downward trend of nominal GDP growth all the way back from the 80s to now. And I think we're at the other side of that, and the big driver of that is certainly inflation and changes the whole market dynamic. The Treasury commentary that I think Michael did, I think Treasuries, move Treasury yields move too quickly to the upside here as well. I actually expressed those concerns as well internally. But ultimately, when you think about what's happening with fiscal spending and the amount of issuances of treasuries, I think ultimately treasuries could actually treasury yields could be significantly higher from here a few years from now. But it's hard to play that right now with the way things have moved recently. So we don't have that in the portfolio right now. So we're just kind of watching that closely. But I'm sorry for not answering your question specifically.
Well, by the way, I will say that one of the reasons I do appreciate Tavi is that he's honest. It's not like anybody that's done the media rounds like I have on the CNBCs and Bloomberg's of the world. There's this old tactic, right, where if you don't know the answer to the question, you say, "Oh, that's a good question," but you know what a better question is. At least, at least Tavi has been honest in that. So
Well, I think ultimately what drives gold higher is what maybe started I think the crypto movement was certainly I've been saying this a very probably the largest libertarian political movement we've had in history. Period. It really reemphasizes this whole thesis that I think a lot of gold bugs have been using, which is questioning the credibility of fiat currencies um, and questioning as well, international reserves that most of central banks hold. And something I've been really also concerned is the fact of how we look at the most credible central banks in the world today, and they're considered credible because they have a lot of U.S. treasuries. And when you think about that for a second, it's owning debt from another largely indebted economy. And in my opinion, I think that's perhaps about to change when it comes to the improvement, the necessity of central banks having to improve their international reserves. And I think gold is going to play a big role into that. Can Bitcoin and maybe other crypto assets play a role into that? Perhaps. I mean, I'm not it's not what the base scenario is. What we are looking at, we think gold will play a bigger role into that. I think gold will also play a bigger role when it comes to the 60-40 portfolios. I think that's those changes in correlations, given the fact that I think we're in a different macro regime, will also cause reallocation of assets into gold. I've been a firm believer of that. Obviously, I've been wrong in the last days and weeks here. Gold hit new highs and it's been selling off relentlessly recently, and it's been difficult to watch. But it's ultimately, it's been our focus to own and accumulate assets in the space, as we think it's hard to believe gold prices would be lower 5 to 10 years from now. Again, that's just my view. And if you are of that view and you think there is a case that gold could be drastically higher in prices from here, I think you want to be taking more risk and looking for those even more interesting opportunities when it comes to exploration and development part of the industry in mining. And so that is why we decided to focus and shift our focus mostly into that and work with the geologists to seek for those opportunities. But again, that's just my 2 cents on, and the strength of the dollar has been also a big portion of recently of what I think hurt gold. And gold is an asset that tends to, every time it hits new highs, it tends to struggle. We've seen this many times in history, and the second leg of gold is usually what tends to be the most intense one. And I think potentially that could come in with some sort of reversal of the Fed policy, and I think that there's certainly a possibility of some sort of macro event like that would trigger that setup for gold. I mean, the macro thesis is intact when it comes to the drivers. It's just a question of that. What's the real trigger here? And I think the potential for maybe it's yield curve control at some point. Maybe it's just a reversal of the tightening cycle. Who knows what's the potential here? But it's maybe it's the deep recession that we may come in, and maybe the depression scenario that Mark was referring to, which is a possibility. All those could be important market developments that can shift I think the sentiment in the gold market. And it's incredible. I mean, it's everyone is still so bearish on gold when I think it's a very interesting thesis still, and so I mean we just remain focused on that part and have other themes to capitalize on.
By the way, I will say real quick, back in, I think it was April of 2020, I put a piece out on Seeking Alpha saying the only way out is either hyperinflation or defaulting to the Fed. So at least there you have, one person, and maybe a few more. But go ahead, Tavi.
Well, I mean, it's the debt to GDP problem is I think most of us would agree that inflation is one of the routes to fix that problem. I think hyperinflation, just like depression, is a possibility. It's definitely priced in with a higher. You're paying a premium for that risk right now, given the fact that I think inflation is more of the narrative today. So certainly a lot cheaper to bet on a depression versus a hyperinflation right now. But my understanding of hyperinflation is that those developments are also things that happen through when smart capital starts to really leave capital markets in general. And so I use it as an example. It's been Venezuela or even Argentina or Brazil in the 90s, where you start seeing large corporations leaving the country and going elsewhere. And you start seeing that downward pressure on the currency by those capital outflows. And then as smart capital leaves, you start seeing a shift in political environment. When in most of those times you see some sort of um, populist leader that starts to gain momentum as a way of a hope for a shift. That hope is unfortunately never really comes to fruition as we see authoritarian regimes take place in as a kind of a resolution of all this. But that's really the shift of the capital of smart capital is really the beginning of that. Do I believe we're going to see that in the U.S.? I don't think so. But I think I can change my view along the ways. I'm not betting on hyperinflation. I don't, if that happens, actually, it'd be great for a portfolio. But I don't foresee that in the next years or so here. I think we have. What's happening in Japan is quite interesting. It could perhaps play as an interesting scenario when it comes to the rise of cost of capital in a very levered economy, being forced to now really expand their monetary base and purchase those instruments of JGBs at unlimited amounts, and driving yields lower in an already inflationary environment. It's a scary type of market regime that we may see here in the U.S. and that I think it's extremely negative for any fiat currency relative to a tangible asset, and why we saw gold rising in Japanese yen terms recently, and also versus the dollar, which I think that there is a potential for that in places like Europe and the U.S. as well at some point, but. Yeah, I'm not sure. Just putting again my trader's hat, not as so much as an investor. It's hard to bet on hyperinflation when you had the developments that we had in the last 12 months, 24 months or so. It's a lot more difficult to make that bet right now, given the fact that a lot of people believe in inflation. But inflation is a psychological shift, as a lot of other folks have spoken about, and it changes consumer behavior. And I think, where maybe I would have a different view with Mark, respectfully would disagree, it would be on perhaps certainly we've seen that shift psychologically in terms of the consumer behavior here in the US. That kind of reminds me what I've lived through in Brazil. And I think it's hard to reverse those patterns. And I think we're going to see a lot more than that, not less, when it comes to decisions in general that the consumers have when it comes to spending capital. But anyways, I don't think hyperinflation is so much of a risk for short term. But again, I would benefit from that personally, but it's not my base case. Well, I think that's a challenging question just for energy in general. Has been is a little bit different than other parts of the commodity space. I mean, we've been struggling finding energy companies that are not hedging the energy prices when it comes to when they're generating their free cash flow. It's been a challenge to find companies that are on the other side of that and taking the risk of and benefiting from the rise in oil and natural gas. I think that's goes back to an earlier question I believe Jeremy asked regarding if you should own the commodities or actually the producers. I know we own both, and so it would maybe be a problem with our producers if something along those lines, more extreme that you were referring to, would occur. I think certainly it could potentially be negative for those investments. But I would think that ultimately we would still, I think we would still see higher oil prices. Personally, I think that the supply side of it is much more severe than the majority of people think. And but I can speak with more confidence with metals than energy, because that's our background when it comes to what we've been working on in the last couple of years in the mining space. Um, Look, I think we've had some developments like that in other parts of the world, more emerging markets, when even Brazil has gone through a lot of that, even nationalizing some of the companies, becoming state-owned companies, and so they can have a better handle on amount of production that comes out of those corporations, and the biggest impact of that tends to be, believe it or not, on the FX side, and that's a risk to the dollar if we start seeing, I think, very severe changes politically speaking, in those terms, and if that's going to happen. Now, I would think that as a just looking at our portfolio, I would think that gold would perform very well in that setup, but um, again, you're throwing a kind of a more extreme scenario at me. I think we're seeing some of those changes today politically. Absolutely, the windfall taxes and so forth. I think that's all the especially the involvement of politicians when it comes to how much production those oil companies will be having in the future here. I think that's all valid points, but I think ultimately the supply issue to me is what drives the physical commodity much higher in prices, and I I think this is very different than other environments. I don't think this is 08 at all. I really think we're going to see oil prices continue to rise from here, natural gas as well. And I think it's going to happen across most commodities. And agricultural commodities are also going to go the same way too. So hopefully I answer your question. I think I've never seen an environment where these companies are making this much money. It's sort of insane when you look at, especially free cash flow estimates for energy companies right now. It's absurd how much they're generating. They're really printing dollars right now. It's some of those companies. Just looking at Shell, was is as an example, is making more money than what the Federal Reserve was buying in treasuries on a monthly basis. I think they're what 20-30 trillion billion dollars right now in terms of free cash flow they generate every on an annual basis. Just put that in perspective with what QE was on a monthly basis. It's kind of interesting, but they're making a lot of money. It's incredible. But the political environment, I think it could shift more negatively in terms of that, as you said. But ultimately, I think the physical commodity will continue to benefit. Commodities to equity ratio is at a 50-year low, and we've seen this in the 70s, we've seen this in 2000s, and this is not a short term trend, and I think oil will play a role into that. Where sure, we may get caught up here and there with bear markets along the way, but I think the cycle overall for the next 5 to 10 years is that commodities should outperform overall equities. And I think that's been the focus when it comes to portfolio positioning is how do we really look for the best investments in the space, that can actually really benefit from those trends, regardless if it's politically or macro. But I think this is a different regime than what we saw back in the last decade or so.
I think that's a good place to end the space. Again, everybody, I'm going to make this an edited YouTube video probably the next week or two. I feel like I've been through a marathon, like I just watched Avengers all over again, with Tavi Costa as the special guest. Again, everybody, thank you so much. Really do appreciate everybody's help. Tavi, you're the man. And Tracy, I will see you tomorrow. Thank you, everybody.
Thank you very much.